Today, April 27th, 2026, Plug Power stock is trading at $3.14 per share, marking a decline of about 1.26% during this Monday morning session. While a dip of 4 cents might seem like typical market noise, the reality beneath the surface is far more complex than the daily ticker movement suggests. The immediate expectation for many retail investors using platforms like the Robinhood app or browsing popular investing sites is that Plug Power is finally catching a second win following its massive 59% rally earlier this year. After all, the market just saw the stock jump significantly last week, fueled by a mix of geopolitical headlines and a broader surge in speculative assets. However, the reality is that we are witnessing a classic tug-of-war between high-frequency trading momentum and a very sobering fundamental transition. While the crowd is cheering for a meme-style breakout, institutional heavyweights are quietly recalibrating their positions based on a new leadership regime and a liquidity roadmap that is much tighter than the public narrative often admits. The disconnect between expectation and reality here is striking. The market expectation is built on the idea that Plug Power is a hyper-growth tech play that will eventually mirror the trajectory of Nvidia stock or Apple stock in their respective sectors. But the reality is that Plug Power is currently a heavy industrial turnaround story masquerading as a green tech unicorn. Most investors see the recent contract wins and the appointment of Jose Luis Crespo as CEO as a signal that the hard part is over. In truth, the hard part, actual disciplined execution and margin expansion, is only just starting. We are moving from the dream phase of the hydrogen economy into the gritty operational phase, where every cent of gross margin matters. If you are looking for investment help on whether this is a long-term winner, you have to look past the intraday fluctuations and understand that the company is essentially trying to rebuild its engine while flying the plane. They've managed to post their first positive gross margin in late 2025, but the market is already pricing in a perfect landing for their 2026 goals, which leaves very little room for error. Recent stock movement has been a roller coaster, with the price swinging between a 52-week low of 69 cents and a high of $4.58. This volatility is a playground for those using a Fidelity trading platform or Robinhood stock trading, but it's a minefield for long-term wealth management. Institutional activity shows that major players like Vanguard and BlackRock still hold massive stakes, yet the fund sentiment score remains cautious. The volume we are seeing today, over 76 million shares, indicates that there is still plenty of liquidity, but it also shows a lack of consensus. Institutional investors aren't just buying the green future anymore. They are looking at the $132.5 million property sale to Stream data centers and the $275 million liquidity plan as survival tactics. When a company has to sell its own real estate to fund operations, it tells you that the traditional investment thesis is under severe pressure. This isn't the same environment as a self-investing setup where you can just buy and forget. This requires an active, almost forensic eye on the balance sheet. Comment below how many shares of Plug Power you currently hold, and whether you think the new CEO can actually hit the positive EBITDA target by the end of this year. To understand why the stock is behaving this way, we have to look at what Plug Power actually does. They are essentially the vertically integrated backbone of the hydrogen world, handling everything from the production of green hydrogen to the fuel cells that power forklifts in massive warehouses for companies like Amazon and Walmart. Their business model relies on Gen Eco electrolyzers and cryogenic technologies to create an ecosystem where hydrogen is as easy to use as diesel. In the past, they grew by burning through capital to build scale. They reported about $710 million in revenue for 2025, which sounds impressive until you see the net losses and the non-cash charges that frequently hit the bottom line. The Project Quantum Leap initiative they launched was supposed to streamline operations, and while it helped them reach sustainable profitability in their material handling segment, the broader green hydrogen production side is still a massive cash sink. Older reports often highlighted the infinite potential of hydrogen, but the current reality is that infrastructure costs are high, and the sales funnel, while valued at $8 billion, is slow to convert into actual cash flow. When you compare Plug Power to something like Tesla stock, the differences in maturity are obvious. Tesla has reached a point of self-sustaining cash flow, whereas Plug Power is still heavily reliant on external capital and asset sales. This is why many people seeking online investing advice are torn. On one hand, you have the potential for a massive recovery if they hit their target of positive EBITDA target by the end of quarter 2026. On the other hand, there is the constant threat of equity dilution. If you're using Interactive Brokers Trading or a SoFi Active Investing account, you're likely seeing the wide range of analyst price targets, some as low as 50 cents and others as high as 7. This dispersion is a red flag that the professional community has no clue which way the wind will blow, because it all hinges on execution, not just market demand. The future outlook for Plug Power is a high-stakes gamble on two specific catalysts. The first is the extension of U.S. hydrogen tax credits through 2027, which provides a much-needed policy tailwind. The second is the ability of the new CEO to transform a growth-at-all-costs culture into a profitability-at-all-costs machine. If they can achieve positive operating income by late 2027 as promised, the current $3.14 price point will look like a steal. However, the reality is that they are facing growing competitive intensity in the sector. Other companies are entering the electrolyzer space, and the cost of capital remains a hurdle for large-scale green projects. If the macro environment shifts and interest rates stay higher for longer, the cost of funding these multi-gigawatt projects could become prohibitive, forcing even more asset sales, or worse, significant dilution for existing shareholders. Looking at the technicals, the stock is currently hovering above its 10-day moving average, but still struggling against a cluster of longer-term averages near the $2 to $2.50 range. The fact that it's holding above $3 today is a sign of resilience, but it's a fragile resilience built on the back of meme stock momentum rather than a fundamental breakout. For those using a SoFi robo-advisor or Schwab Intelligent Portfolios, this stock likely isn't a core holding because of its risk profile. It's an individual brokerage play for those who have a high tolerance for volatility and a long-term belief in the hydrogen transition. The tension between the expectation of a green revolution and the reality of an industrial turnaround will continue to define the price action for the rest of the year. If the company misses its Q1 2026 margin targets, expect the floor to drop out as the expectation of a quick recovery vanishes. In summary, the central insight here is that Plug Power has moved out of the speculative dream phase and into an execution phase where the margin for error is razor thin. Investors expected a seamless rise alongside the broader market, but the reality is a stock that is deeply tied to its own internal restructuring and liquidity management. We've seen a shift from aggressive expansion to asset monetization, and while the new leadership brings hope, it also brings the pressure of meeting very specific financial targets. The contrast between the retail-driven rally and the institutional caution remains the dominant theme. Plug Power is no longer just a bet on hydrogen, it's a bet on management's ability to stop the bleeding before the market's patience runs out. Whether you use Fidelity Investments, the SoFi trading platform, or a Robinhood app, the key is to watch the cash burn and the gross margin progress more than the daily price swings. The authority in this trade comes from knowing that the story has changed from technology to accounting, and only the investors who track the latter will survive the volatility ahead.